Welcome to Volume 5, Issue 21 of the Master and Investing Newsletter. This week's ex-dividend date is the 23rd of May 2019. Okay, what can we expect this week with the dividend date of the 23rd of May 2019? We've got 5 candidates: Morrisons Supermarkets, Imperial Brands, Carnival Corporation, Bunzl, and DCC. We can see that there's £1 billion on offer, with the biggest payers being Imperial Brands at nearly 300 million. We've got Carnival Corporation at 290 or 286 million, and then we've got Morrisons paying out 209 million. Bunzl 118, rounded up, million, and then we've got DCC at 92 million. The whole thing is $1 billion. And let's have a look what's going on. For professionals, we can see that the dividend of 4.1%, and that's huge, by the way, of 4.1%. Morrisons is literally being very generous. And for those who can get the 5% margins, that's going to, on a derivative, that's going to be equivalent to your 83% return on investment. Okay, 83% for professionals and 20.7% for non-professionals. So this is a number we definitely need to pay attention to and see what we can expect from that. And we'll look at that later on. Imperial Brands, a more respectable 28.9%, Carnival 19.8%, Bunzl 16.5 and 13.4 professionals, and we've got 7.2, 5%, 8.3, and 6.7 for non-professionals. If you're going to buy the share, you're going to receive a dividend anywhere between the 14th of June or the 18th of July, in that range, between 3 and 8 weeks. Okay, and if you're going to go for the derivative, you'll receive your dividends on the 23rd of May, 1 day later, for the derivative traders. Okay, let's jump straight in. Morrison Supermarket is engaged in the operation of retail supermarket stores under the Morrisons brand and associated activities. The company offers products such as Freeform, World Foods, Food to Go, and Nutmeg clothing. It has food manufacturing capabilities in meat, fish, bakery, fruit and veg, deli, and flowers. Its Morrisons branded beef, lamb, pork, chicken, milk, and eggs are sourced in the United Kingdom. The company serves customers across the UK through approximately 500 stores and an online home delivery service. It operates from over 10 manufacturing sites across Britain. The company operates over 7 regional distribution centres and a national centre servicing its supermarkets. Its subsidiaries include Boss Brothers, Fruit and Veg, BV, Erith Pier Company Limited, Fursdale Limited, Kiddie Care Properties Limited, MHE JV Co Limited, Neerock Farming Limited, Neerock Limited, Rathbone Care Limited, and WM Morrison Produce Limited. What you can see just from that little list is that they are vertically integrated. So what does that word mean? A vertically integrated company. It means that the shop itself owns, and not only does it own the retail outlets, but it also owns the suppliers. So in other words, instead of buying from a farm to then service Morrisons, it owns the farm that services Morrisons. So this is what I mean by vertical integration. Not only does it own the retail outlet side, but it owns the supplier to the retailer. So typically you would get a retailer buying from a wholesaler, buying from a manufacturer stroke a farm. And in this case, they own the whole chain. They own all 3 of those segments. That's what they're telling us here. David Potts is the CEO and Trevor Strain is the CFO. They're worth £5.1 billion if you bought all the shares at the current price. And they're number 87 in the FTSE 100. So in the last 6 years, had you bought this company for its dividends, you would have had 13 opportunities to trade this stock. 7 out of 13, 54% of the time, you would have gotten your money back within a week. Had you traded this? Once, it would have taken you 8 days, which is obviously more than a week and less than a month. And that's 8% of the time. And 5% of the time, it would have taken you more than a month to get your money back. Anywhere between 36 days and 415 days. That's over a year. But essentially, in the last 6 years, everyone got their money back if they had been hanging around and waiting. And that is 38% of the time. What about for short traders? Well, had you been a short trader and you went short 5 times out of 13, which is 38% of the time, you would have made money going short on day 1, and 54% of the time, which is 7 times out of 13 on day 2. Your ROI was anywhere between 5%, 4%, and 54%. Now, 54 is clearly an outlier. So the next best one is 12%. So, you know, between 4 and 12% is your typical ROI. And for that was day 1. And day 2, anywhere between 1 and 35%. Again, 35 is an outlier. So the next best is 15%. So anywhere between 1 and 15% is what you could expect for this one on day 2. Let's look at their fundamentals. What's the balance sheet and the saying here? Or what's their numbers saying? So let's look at their revenue. We got 16.8 billion in 2015, and that drops to 16.1. It bounces up 16.3, up again 17.3, and up again 17.7. So really, from 2016 onwards, we're marching up. In 2015, they reported a £792 million loss. So clearly 2015 was ugly for Morrison. They then get back on track with in 2016 with a £217 million profit, £325 million profit. The following year, 380, and then it drops by 60 million in 2019. The profit does to 320 million. And again, we can see by looking at these two numbers what's going on right here. So basically, for every £100 they sold in the shops, received in the shops, £2.20 became profit in the bottom line, compared to £1.80, 1.8%, £1.80 being profit in the bottom line. And they're basically, you can argue that there are some costs that they haven't quite got under control. It could be, and obviously with a supermarket, there are things you really can't easily manage, like wastage of food, people nicking your stuff in the shops. Now, yes, you can hire security and you can put cameras in the shop, but the truth is cameras and security can't stop everything disappearing off the shelf inappropriately. And people don't buy the things quick enough, and it goes off, and it has to be thrown away. So you can get costs slipping from those reasons. But if you can manage those processes quite well, you should be able to make this work for your benefit. And clearly they're going to have a percentage slippage or a percentage wastage number, which they're going to be working with. And as long as they don't breach that number, then everything is kind of basically under control. Let's have a look. Now, these guys wanted to pay a dividend of £209 million. Well, they have profit of 244, and they've got cash in the bank of 264. So I would say that these guys are, Okay, these guys are catch rich, right? Because when you go in the shop and buy the stuff, you have to pay for it cash. But they haven't got to pay their suppliers, which they own, but they haven't got to pay their suppliers for 30 days using normal credit terms. So effectively, real estate, retailers are going to basically be quite liquid because of that phenomena. All right. We also said that this company was worth, we said they were worth 5 billion, 5.1 billion. The balance sheet, this means all the assets minus all the liabilities. In other words, if you basically was just buy the company and then scrap it by selling off all the assets, paying off all the liabilities, and leaving behind what was left over, you were left behind with 4.6 billion. They're for sale for 5.1 with a 4.6 billion book value. Do you know what? Their share price is kind of, I would say that, technically most people's stock market price is higher than their book value, in most cases. But this is practically the same. I know it's 4.6 going to 5.1, but I would say that this is fair. This is a good price. It's a good price. However, if you look at their profit margins, it's 1.8%, 2.2%, 2%, 1.3%. These are very, very thin, meaning when you get into problems, you notice it straight away because you don't have too much fat, or too much meat on the bone of this particular business. So businesses with very thin margins, as I keep saying, when you've got a very, very thin profit margin, unless you have got high volumes, this can't work for you. So remember, all entrepreneurs who are in business and you want to give away your products for cheap or free, or not free, but cheap, because people ask you for discounts, be careful. Thin volumes, thin margins will hurt you, and it will make you basically non-viable as a trading business entity. So be very careful of this. You need generous margins if your volumes are low, and most small entrepreneurs, their volumes are low. But here's an advantage that these guys have, because they have the ability to scale. They can actually reduce their prices to much lower than you could if you had a corner shop. If you had a corner shop and you were selling the equivalent of what Morrisons was selling, you could not sell as cheaply as they could and be in business, because if you had these thin margins, you'd go bust. So this is where their buying power is really working in their favor, because the bigger you are, the cheaper you can sell your products for and still make a chunk of change. So it is what it is. Something to think about, really. Okay. Next one. Let's look at the 5-year trend. So we saw that from 2016 onwards, their profits were going up. Apart from 2019, profits were going up and the turnover was going up. Okay. What was the share price doing over that same period? Well, we can see from 2015, it's trending up. It comes down a bit at the end of 2017. It starts to go back up again in 2018, and now it's on a downtrend. So really, from the middle of 2018 onwards, September, this has been falling. It's been in a downtrend. And you can see that it's coming close to the bottom of the Bollinger, but it could push it down. But if you look at the RSI is in the middle. So this could still fall some more and still be fair value. It could fall some more. So we can see that the drop in profit, this drop in profit has softened the share price. So we're in a downtrend, and we've been in a downtrend really since September last year. So what's our summary? Our summary is that on the long side, Carnival and Bunzl at 67 and 63 have the best track record of rewarding long traders. Morrisons at 54 is kind of above 50%. So, you know, it's just edging it a little bit. But if I look at, for short traders, we've got 17 here, which is the worst, and 25. And so if you want to go with a company long, you want the long trend to be good and the short trend to be rubbish. And I would say this one meets that criteria. So Bunzl really is the best for rewarding long traders. And on the short side, the best ones would be Imperial Brands for short traders, followed by maybe Morrisons and then DCC. But if we look at this detailed analysis right here, we can see that this is how long it takes to recover. Carnival in the last, since the end of the last quarter, sorry, the last half of 2018, having 1, 1, and 0. And then you had these big long waits. And then after that, again, short weights. So the recent history, with the exception of the beginning of 2018, is that they give you back your money quickly. That's Carnival. Imperial Brands, 86, well, this is not even recovered, 86 right there. And the last time, 81 days, 267 days, 36 days, 76 days, and then it gets kind of reasonable. And then again, you got an ugly one, 730 here, and 1,000 in 2016. I don't know what to say other than, wow. And these gaps represent, because around this time, they were paying dividends twice a year, around this time. And then they switched to, in 2015, they switched to paying dividends quarterly. So this gap isn't that they weren't paying dividends, it's just that they weren't paying dividends quarterly. Let's look at Morrisons. Morrisons returns your money relatively quickly, with the exception of this horrible 415 in beginning of 2018. But you know what? If you take that one out of the way, Morrisons is not that bad a performer on the upside, you know. Not bad performer. DCC, it took 369 days and then 59 days, and then it was okay, and then went big numbers, and then it was okay again. So this one's inconsistent, DCC, for rewarding long traders. And then we've got Bunzl, 1, 24, and then you got this huge long wait. And then you got 5, 36, 0, 8, 0, 6. So, okay, they're really good. So even though this one said 60%, it was really most distant history. The recent history is more shaky. It's shaky. So from end of 2017 or 2017 onwards, it's inconsistent. Long wait, short wait, long wait, short wait. It's inconsistent going forward. So if you're going to go long, it looks like Carnival has the best recent track record of rewarding long traders. And then you got this little run here, you know, from 2016. And then you got this hiccup right here. And then you got a nice little, again, good results for short traders, for long traders, sorry. And then Morrisons, again, not too bad, apart from this 2018 horrible nightmare. For anyone who went long, this would have been a nightmare. And it's funny, actually, because my memory of Morrisons, when I was trading Morrisons back in 2013 range, I don't have pleasant memories of Morrisons being a good company for going long. Because back in those days, I was going long only. and I don't have a good memory of them. So I must have got caught up in its 82-day business, because this one left a bad taste in my mouth when I was going long and had to wait forever to get my money back. So Imperial Brands, well, this is ugly all day long for long traders. So you might argue that Imperial Brands is a good one for maybe going short. Let me look at their return on investment. Imperial Brands, we are talking about ROIs day one between 2% and 29% on day one. On day two, between 1% and 70. 55 being next best, and after that was 20. What can I tell you? And then you got some thin ROIs after that. Well, the numbers are there, so you can actually look for yourself and make your own assessment. So if I was going to go short, I might lean towards Imperial Brands for going short. And if I was going to go long, based on the stats, historical stats, I might lean towards Carnival, based on historic track record. Okay, historic track record. They pay quarterly, so we're now coming up to second quarter. Second quarter was 0. Second quarter here was 21, and then whatever. Second quarter 6, second quarter 7, second quarter 49, second quarter 0, second quarter 21, second quarter. Anyway, you could argue that Morrisons might be a better bet if you ignore that 415 and treat that as an anomaly. Then you can say that you're getting money relatively quickly, as long as you want to put that to one side and say that was out of character. But that's what the history is telling us. So enjoy making a decision. And if you found that useful, remember to press the like button. This is Miles from Milestone Investing. Happy investing.